Hey, welcome to the Tokenomics live stream. It's Monday. It's nearly lunchtime actually. UK markets are looking okay, actually up about 0.5% in the FTSE, about 7230. We've seen over the weekend, if you've been following the news at all, Evergrande have paid one of their debt obligations they had to pay, which was a 85 million or billion. I imagine it's million. Probably should have more information. Don't massively care. They paid it, and so that's pretty positive. It means the market's not going to tank this week, which is a result. Got in the UK, we've got the budget, which is for those of you who are international viewers. The budget in the UK is basically where our Chancellor, who's our Treasury Secretary, has a little red suitcase. He walks into Parliament with his red suitcase. Actually, he's allowed to drink alcohol, although Rishi, our current Chancellor, doesn't drink. But he can. He talks about the budget, so he talks about how we're going to turn the economy around this year, what we're going to do, what taxes we're going to rise, what things we're going to cut, how much more money we're going to put on alcohol, how much more money we're going to put on tax we're going to put on cigarettes, those sort of things. That's what's in the news today, this week, and that will affect certain movements in the markets in the UK. Are they going to fund certain things? It's always a bit of a damp squib, really. I don't actually know what a squib is, but a damp squib, it just means nothing much comes of it, but it can cause a bit of nervousness in the market as to which sectors, like retail sectors or hospitality, are they going to get any help out? That's about that in a nutshell. That's what's going on this Monday morning. What else we've got in the US market? We've got the Dow futures looking to open up in the next couple of hours. We've got another ETF, another Bitcoin ETF going live. I think it's the VanEck one. What we found actually last week, and some of the new ETFs have the additional ones after the first one, are getting money going into it in Bitcoin, but they are kind of never going to do as well as the first one, are they? If you're a big investor and you're looking to invest in one of the ETFs, you would invest in the first one probably. If you want to invest in a futures ETF of Bitcoin, but the others I think the other CEOs of the other ones are putting on a good face. Oh, we're definitely getting subscribers, but I don't know why you'd necessarily put money into them unless they've got their own existing client bases and they can just move it across. Maybe that's what it is. So we'll have a few more of those. There's quite a lot of those Bitcoin ETF futures coming on board, and we're seeing Bitcoin really tacking close, very, very close to that Plan B. It's a nice stock to flow prediction. It was the worst case prediction he did. The worst case, I think it was the on-chain metrics prediction he made a while back now, which was to end this month of October and Bitcoin $63,000. Now, he's been right pretty much every month the last few months, weirdly so. If this month he nails $63,000, I mean it's 62.7, 62.8. I'd bring up my screen. I haven't actually got up my screen. Let's check my phone. What is it? 62.8. If he brings up 62, if he gets to 63, and we've got 5 or 6 days left, it's going to melt faces. It's going to be ridiculous. This guy should just quit and go, actually ignore everything else I've ever done. I'm just going to quit. I was right. But that's interesting. I think if the amount he's kind of he's the institution's influencer. So if he's right again, his next month after that is about 100k. And I suppose that's probably where it would go. Realistically, I mean, I like Bitcoin. I think it makes a lot of sense. I come from a background of I just thought I'd spend a few minutes before I go into what I want to talk about today. And I'm going to talk about, let's just do that. Today I'm going to talk about two different areas. I'm probably going to split the video up and edit it and relist it. First one, we're going to talk about an update on the Sappy Seals Metaverse. So I listened to the Sappy Seals Twitter Spaces last week. I wasn't totally informed when I did a stream on Friday, but I have then listened to it again. I got the link from Wab, who's one of the founders of the group. I listened to the whole thing again, and I understand now where they're going. And I think it's actually very interesting for not just for Sappy Seals, but for other avatar projects as well. And I'll cover that. I think it's very positive information, positive news. Second part, I want to talk about why floor sweeps are bad. Now, let's just caveat this very, very carefully. There's nothing wrong with an NFT project buying tokens of theirs off of the floor for certain reasons. So it could be for giveaways. It could be because they're going to put them in charity storage. And CryptoDads did it very early on. Buying items off the floor to put into a liquidity pool, which is one of the things that Winter Bear did. They started the liquidity pool. They took the first leap. They said, look, we'll buy some bears, put it into the liquidity pool, and we'll get you to learn about how you can stake your bear. That's nothing wrong with that. That's a short-term move, not to underpin the price, not to trick new investors with essentially Ponzinomics, and we'll get to that as well at a later point. But it's a means to an end for something else. a lot of people in Discords, I see them, particularly often new NFT users, go, oh, they're going to sweep the floor, they're going to sweep the floor, they're going to buy them off the floor, they're going to bring the price up. That's not good use of your project's funds. I'm going to get to this. It's a similar reason why big companies give dividends and startup companies don't. Not because startup companies can't afford to give dividends, it's because startup companies believe they can scale far more with the money in the business account to give you a far stronger returns on your capital employed. I'm going to basically bring a bit of intel, a bit of knowledge that I would understand from my stock broking background and explain to you why you may want to change your perspective on floor sweeps being a good thing when it comes to NFT projects. That's going to be the second part of the video. The first part, Sappy Seals. And I've completely lost my chain of thought what I was actually going to cover before that. Oh, I was going to talk to you a little bit about... No, it's completely gone. It's completely gone. Let's just talk about Sappy Seals. So let's just bring up the bring up my screen here. So let's get that down. I'll remember what it was in a bit, and I'll go off topic and talk about something else. Right, let's. There you go, that's a footsie. Let's start with this. This is brilliant. Someone's done a cameo for. So someone's done a cameo video with the Island Boys for Sappy Seals. It was hilarious. They called it ARF rather than ARF, and underneath they've replied to Crypto Joe Rogaines. A big opposite of a thank you. It's brilliant. It's amazing. Love it. Absolutely love it. Anyway, so Sappy Seals, if you haven't seen them, they're an NFT project based around seals, I suppose, is the thing. They don't take themselves too seriously. They've got a pretty friendly Discord. That's pretty much as I need to go into that one there. For those of you who've got Sappy Seals, you'll know. You do see a lot of meme stuff, which is pretty cool. I do like these things when you see the communities actively creating stuff within it, kind of within their own ecosystem. It's pretty cool. But what I wanted to cover was this stuff here. Let's go to the Metaverse bits and bobs. They did post out some teasers, doing some bits and bobs with winter bears, but where are we at? Let's try and find it. All right, so there you go. You can get it here if you want to listen to the actual roadmap that I'm going to be talking about here now. I've made some notes. I'm going to go through a few things with it. For those of you who either didn't listen to it, or for those of you who did listen to it but aren't quite sure what they're supposed to make of it, what does it mean? I did make a few notes, and I really wanted to just touch on a few of the core key points. So, Sappy Seals, when I first looked at them, they were talking about creating a concept called the Blubber DAO token. It was going to be a DAO. It was going to be a DAO. So first of all, DAO is a decentralized autonomous organization. You generally would have tokens for a DAO because you stake them within the DAO community to show that you actually have the right to vote and to get involved in governance. Less of a financial token, more potentially of just a voting token for a lot of DAOs. And it means that you can all participate and you can make decisions as a community. So rather than being one central leader who makes decisions for everyone, you all work together, and maybe a central leader might propose ideas, or you can all propose ideas, but then you all vote on them and you stake your tokens to say, hey, and a token essentially would be like a voting polling card. In the UK we have these little polling cards. I don't know what you have in America, but we go down to a church hall or a porter cabin or a loo somewhere and we go, here's my token, or a library, and there's no ID checks whatsoever, and you just vote, and it's really spurious. That's kind of how a DAO token can work. It doesn't have to be, I get a yield on it. It's just a token that you go, hey, here's my voting token. I'm lodging it with this website, with this platform. Now I can make a vote on this governance issue. And the governance issue could be anything from, shall we change the font for the logo, or shall we invest in a project, or whatever it is. So that's that in a nutshell. And so they were going to call it the Blubber DAO token. Now, they've done a bit of a teaser here, and a lot of people don't necessarily get this. And the teaser is, we may not call our DAO token Blubber anymore. And so a lot of people are like, oh no, it's a really good name, I like it. No, there's more to it than this. And this is if I can try and break down the whole point of what their Metaverse Twitter Spaces was about. And it was this. They saw a problem that if you only have 10,000 avatars, and probably 5,000 to 6,000 if you're lucky holders of that avatar within a community, how many people can play your Metaverse game? Limited, right? Now I know some projects out there are talking about, and I hold Paladin Pandas. I'm fairly ambivalent. I think I like the artwork. Like the artwork? No, you don't. You want to make a return. It's a game project. It was cheap. I buy it. I buy some stuff that's cheap. I think, okay, ticks a few boxes, whatever, I get it. I don't do much research on some of those things. More money, I will research it. But if it's just small change or I've got some loose change in my ETH wallet, I'll buy it. So don't judge me. Or do judge me if it does really well. Then think I'm an absolute genius. Right. The point being, and they're going to try and rent out their pandas. And I think another project out there are talking about renting out their things. And this is a flaw, I think, and in some of these GameFi projects. I'm not an expert. I haven't spent a great deal diving into it, but it's a flaw in my head. I don't get that just yet. You rent a player, I don't know. Maybe I guess you rent it or you're paying a token to pay. Anyway, I don't want to get caught down that rabbit hole, that panda hole. The point being is, if you have a very, very small metaverse community, how many people can actually play it? If you have these metaverse communities with only 3,000, 4,000 holders, maybe not all of them are even active. When you look at Discord, you might be in a project that right now that has 10,000 avatars, 4,000 owners. How many are in the Discord at any one time? You probably see the same faces over and over again. It might only be a couple of hundred. It might even be less than that. You have a lot of people who just watch and don't really participate. People who log in who don't participate. So you're talking about a very, very small community ultimately. And I think Sappy Seals have seen this as a potential problem. So everyone's going to go out there and they're all going to make their own metaverse. And so a lot of people are just going to leverage things like Sandbox, which doesn't necessarily allow you to use your avatar in the way that you probably would imagine you would use your avatar. So if you were a pudgy penguin and you're walking through Sandbox, you wouldn't be a 3D voxel of a pudgy penguin. You probably would be their set avatar characters that work within their framework, and you might have a little token PP or something on there. That's something that Sappy Seals are saying. They're like, well, that's not going to work. People lose their identity of their avatar that they're so proud of. If you've got a crypto dad, you want to be strolling around like a crypto dad. If you want to be a seal, you want to be flapping around like an ARF boy. So they thought, how do we fix this? How do we fix this in a way that can still return value to investors? How do we fix this in a way that makes it actually a useful metaverse? And so they thought very simply, well, let's just team up with other people. Metcalfe's law, and let's just show you this. So this is, have you ever heard of Raoul Pal, who's one of the hedge fund guy, ex-hedge fund guy who's very big into, he runs Real Vision Finance on YouTube. Very interesting guy. Wrote some very interesting thesis on emerging economic growth. What do they call it? He uses the phrase of the era of, fuck knows. He talks about mass growth. He particularly talks about cryptocurrency being a driver of massive growth, huge growth. The era of exponential age. That's it. The exponential age. Cool word. He's famous for coining the phrase irresponsibly long Bitcoin, which I think is a great phrase. So Raoul Pal talks a lot about Metcalfe's law and network effect. And Metcalfe's law suggests that the value of a network is a magnitude depending on the numbers of new users on there. So if you have 10 users, then it will be 10 to the power 10. So it's a proportional scale. I'm not a mathematician, statistics person, but I am acutely aware of Metcalfe's law. Metcalfe's law is this. So the value of a network is proportional to the square of the number of the users. So if your association has 10 users, the value of the network provides is 100, because 10 times 10 people, each with their 10 associations, and so on and so forth, and it grows and it grows and it grows. And you've only got to look at things like Facebook, and you saw very quickly how actually I'll leave that up there so you can read that. I don't know, I'm flicking around. I've only got to look at the speed of growth of some of these viral networks, like Facebook was in its early days, and Instagram and Snap and all of those, how very quickly it just spans out. You might know 5 people, I know 5 people, or my 5 people that know also 5 people. Eventually it gets to a point where some of these circles overlap and intersect, and it maybe you lose an efficiency of growth. There becomes a diminishing rate of returns. But by that time, the network is enormous, and that network has value. Now, I spoke in the last video about the value of using a network, a community, a brand. So let's use a good example because I'm more familiar. Someone raised this in one of the Discords for crypto dads. Crypto dads is a very easily demographied. It's an easily kind of typecast demographic, I think. And there'll be outliers, but you've probably got an awful lot, statistically more probably, dads or mums, people who've got kids in the crypto dads community. Perhaps more than others, might be more drawn to it. The human face avatar, I think, has has an appeal to a certain age group as well. I just think for me, look, I'm 39. It works for me. I'm a dad. I'm a crypto dad. That's me. I resonate with that. I have other projects, but I don't think of myself as a space boy, or I don't think of myself as a paladin panda. I bought those because they're a pun. But crypto dads I'm a crypto dad, so I resonate with it. Now, people like me are more likely to buy certain brands or certain products than perhaps people who are 10 years younger or 20 years younger or 20 years older. The demographics, I'm the last of a millennial era, and so if you pitch me trendy Williamsburg beer with low calorie, or you pitched me a really cool outdoor barbecue, the big green egg, I'm probably going to be interested more perhaps than an 18-year-old who buys an anime or whatever. So if a community was embraced certain brands, what is the value to that brand for our spending power as a community, as an individual factor? We're a hyper-focused demographic for advertisers to target. So I've spent quite a long time talking about this, but that's the value of a network. That's the value of a network to advertisers. And I think people sometimes forget that these tokens, NFTs, don't have to have utility. The utility actually can be the utility for external forces with money to spend to access these communities. Now, I've been using my Crypto Dad's NFT to help me build up my Twitter follow account. I've been using my Winter Bears access with my NFT to help me build up my Twitter account and to talk more about finance and using some of the things that I've learned and help other people in some way if possible. So there is a value. There's a value to network. I'm finding a value, and I think many other people. Not everyone will find the same value. People will find different things. Some people will be further along the line. Some people might find support value. I saw, Nate.Roth on Twitter said, NFTs are a play against a number of people who don't have real life friends. And there's an awful lot of people who are lonely, who are at home, and NFTs give them a way to make friends and to meet people who are like-minded, who perhaps live nowhere near them, but live the other side of the world. I've got friends who live in the countryside and they don't see anyone for quite a while. All they do is they go to the gym and they work remotely. So I think there's a lot of ways of people seeing value. Not everyone's seeing value straight away, but these things will change. Anyway, that's Metcalfe's law. This is started by VCs, hedge funds, big institutional investors. They look at this kind of data and they go, hey, this is how I'm going to value something that isn't yet making money because the network is getting bigger. Now, let's take that Metcalfe's law network effect discussion and let's apply that back to the metaverse question that Sappy Seals were asking. They were asking, how do we make a small, and a relatively small 10,000 avatar project might seem big in comparison to a 1,500 avatar project or a 100 artwork project from a photographer. But 10,000 probably has 3,000 to 5,000 holders traditionally at this stage. Now, how big is that? That community is tiny. That community is very, very small in comparison. So if you were to build out a whole metaverse for that, how inefficient these developments are going to be. You either rely on an external party's metaverse, and then you become reliant to them. So if they change things, they change the price, they change the price of admission, they change the rules, they change the structure, they don't provide certain facilities, certain opportunities to change things and tweak things, you're at the mercy of the other metaverse platform. So what happens instead if one animal avatar group like Seals said, hey, let's find another one who are interested in the same thing of building communities, building metaverse places, and let's just pool all our resources and actually end up with a network of 30, 40, 50,000 people, 10 projects, 6 projects, 7 projects, a lot more ammunition in our arsenal to develop this metaverse in a way that's a lot more immersive, a lot more engaging, keeps people staying in the community, keeps people within the networks, actually helps each other's communities and each other's networks by kind of trading between, I suppose, or understanding those things. You suddenly become a much bigger network. Now how valuable is it for advertisers to advertise into that metaverse and to distribute the revenue and the value to all of the holders in whatever way that those platforms, those organizations, those NFT projects choose to do. Now, I don't know the exact answer of how they do that, but I do know that while you have in Instagram, for example, if I'm looking for an influencer for a brand that I own or my wife owns, we will engage different levels of influencers, blue chip, mid-tier, and micro-influencers. And micro-influencers can be really, really effective. They can provide outsized returns for the investment. So you might find someone who only requires £100 investment of products, and they may actually give you a return on that of, maybe of their community, 5 to 10 buyers. but you might find someone else who you end up spending £1,000 on, and you only get 7 or 8 buyers. So there's a disproportionate return sometimes on micro focused. However, it requires more energy to manage a bigger network of micro, and there's not always lots of good micro influencers. But then you get to a point where you're too small that you don't earn, as the influencer, you don't earn as much money as you could if you were a bigger network. You could charge more, you could levy more. Just as we're saying there, with the blue chip influencers provide a lower return, but can ask for more. So if you with another community could pair up together, you could build a better metaverse. You could control the metaverse within your organizations and not rely on like Sandbox or Decentraland. And you can earn more, you can value more, you can make a more valuable community that keeps people in your community for longer. They hold the tokens for longer. They build stronger intra-communities which improve the value of those tokens, because people don't want to lose those tokens. They're going to start to become sentimental. You've probably got an NFT project in your wallet that you're sentimental about. And what was it? I think one of the really interesting things that it wasn't WAB, and I feel bad for not getting the name right. I feel really rude for this, actually, for not remembering the name. The point is how many NFTs have you got in your wallet? If you're a Sappy Seal, you probably don't just have a Sappy Seal. If you're a winter bear, you probably don't just have a winter bear. If you're a pudgy penguin, you probably don't just have a pudgy penguin. You get my point. The point being is we've probably got multiple NFTs in our wallet. And what we don't want to do is, if we do start to use Metaverse space, I mean, look, Discord is Metaverse, isn't it? We are spending our days tuned into the Metaverse, into Discord, tuned into Twitter, tuned into YouTube. If we could create a hub that kind of accumulates a lot of that together in a Web 3.0 environment, we don't want to be going from one to another because we've got different NFTs. We would rather be able to use the same one for all of them. That's the principle. It's a very smart principle. It's a very efficient principle, and it actually provides best use of funds for NFT holders, and it gives them the best crack of the whip of doing it. People talk about NFT. We are so early. We are so early. Like it's a drinking game. We are really, really early because I bought this 0.01 NFT. Oh my God, I'm early. Right. That's all very well, but NFTs are going to change an awful lot. No doubt, I'm sure. The NFTs we own are changing. The NFTs we have are changing on a daily basis. Let's just get some more light on the action. Let's get this, illuminate myself. Look like a ghost NFT zombie. If you only have one NFT that isn't really doing a great deal, is pissing in the wind, then you're not early. Well, you are, but you may not capitalize on it. If you are buying into a project that is leveraging the value symbiotically of many other projects, then all of a sudden you are benefiting from being early to some degree. You're reducing your risk. Why? Because if you partner up with a bunch of other NFT projects, if one does really well, the chances are your project's going to get a bit of a kickback benefit. We call that the cousin theory. When you buy stocks, for example, if you have shares in Lockheed Martin, okay, so let's just say Lockheed Martin is going on an absolute tear. People are buying Lockheed Martin. They want defensive stocks, as in actual defensive stocks that fire sexy missiles and blow shit up. If that suddenly became the go-to sector, and we saw Lockheed Martin 10x, there's a very good possibility that all around the world, like ABDMA, the UK, we've got British Aerospace, or Ultra Electronics do like submarine warfare. All these other companies are probably, is it Rocket Aerodyne? They're all probably going to go up as well, because people go, oh, maybe that's the next one. We've seen it in crypto. When we started to see the run-up of ADA, of Cardano, we then started to see other layer one blockchains start to, when we saw Algorand, and then people started looking for the cheap ones. We started seeing Harmony One go up. We've seen Phantom smashing at the moment. Phantom's just a shade under $3 this morning, and still room to grow. The cousin theory, it's called. People are looking for ones related to it. So this is when it's good to be early, or I think it just reduces your risk profile in a very incredibly risky asset. Anyway, so that's the problem they're trying to do. So this is the reason, back to a full circle of what I started with, is why are they probably going to change their token from Blubber DAO? Well, the reason why is because, well, winter bears probably don't have Blubber DAO, and whatever the next one probably doesn't have Blubber DAO as well. So the whole point being is they are going to probably name their token, a bit of a waffle there. They're probably going to name the token something that works for all of the communities. That was the tidbit of information. Now they've announced a pairing up or an initial intro with Winter Bears. There is the talk that there's at least one other project out there. I don't know what it is. I think I read somewhere saying it's another animal one. I don't know if it is. It might not be. It might be. Who knows? It'd be great if it was just pudgy penguins. That would be an absolute steal. I don't know if pudgy penguins are going to do that, but if they did, that would be insane. And you know what? I feel like they probably do need a bit of utility, a bit of metaverse space, so that's cool. And there you go. Here's an example. A pudgy penguin is €2. €2? 2 ETH. It's not €2. Fucking hell, that's cheap. Buy a load. Buy at least 6 today. Got some money. I don't know why I looked over there. I have apples here, actually. Anyway, so they're 2 ETH, right? 2.1 ETH, 2.2 ETH, or whatever. Pudgy Penguins is a very well-established avatar community. But if 3 smaller priced communities like Sappy Seals, Winter Bears, and let's say humanoids, for example. I don't own any humanoids, but first one that come to mind, because someone was hoping it was humanoids, I think I saw on a Discord. If it was humanoids, Winter Bears, Sappy Seals, the combined power of that network, of all those people who are really passionate about those communities, is stronger than what Pudgy Pear project, which is very popular for those who like the fruit-based fat animal avatar. They're launching this week. Get involved in their pre-sale now. The Pudgy Penguins project. That's why I'm struggling, because it's alliterative. So I think they'd struggle. I think they would be losing a bit of weight. And this is one of the other things as well, and why it's important to have a widespread of ownership of tokens. Because if everyone updates their token to a project on Twitter, then all of a sudden you've got more marketing, more power of the network effect, Metcalfe's law. So that's the core takeaway from this Sappy Seals thing. And you might go, well, okay, yeah, cool, they've worked something out. But the point is they're actually now progressing further. So they want to make it immersive. They don't want it to be 2D, completely 2D and barren. First off, it's going to be 2D, but they don't want to make it completely barren. They understand the power of sharing the network increases the value. I've got some notes here that I wrote. What else? They want to launch with multiple communities at first. They actually want to launch Metaverse with multiple communities. Then they want to add in the gamification, because they want the gamification to benefit everyone, and they want everyone to be involved in the gamification to make it like Bears versus Seals battle, which I think is part of the reason why we've been seeing some memes out there saying winter is coming. I don't know, maybe that's what it is. How to fix boring metaverse with no one in it. So this was the questions again I've asked. How to make it engaging for people with small communities. How to stop it being boring, and they don't. They don't want to just be on play to earn games. They want to keep it interesting, and I think that's pretty much the takeaway I got from it. I think I've pretty much nailed it. I've got some notes. I'm just checking if I actually got anything more of interest. That is it. There is probably way more than that. I've probably done a massive disservice, but I gave them a really big disservice on Friday. So Sappy Seals, it's very interesting. It's very exciting. Full disclosure, yes, I own a Sappy Seal because I found one with some bear ears. And if it's got bear ears, I'm buying it. But I only tend to buy things with the money I've earned and I've worked hard for, on things that probably make some sense. Now, nothing in NFTs makes any sense. It's absurd. I spent years and years and years laughing at people for overweighting themselves in crypto and not things like stocks. I come from, a stocks background. I used to be a former stockbroker. That's my background in this. I used to manage private client investment portfolios in blue chip and growth stocks and mid-cap stocks. But I ended up going into NFTs because I do see them as they're just sexy and punty, aren't they? And they're fucking stupid. But I don't know. I can understand. I can get my head around the value of a network probably more than I can get my head around the value of a competing blockchain that doesn't seem to do anything right. And I have questions on those ones as well. So that's that. That's Sappy Seals. Right. I'm going to just, making up the time or whatever. Let's talk about the next part of this stream that I want to talk about, which is why sweeping floors can be a bad thing and potentially a red flag. Plus, I'm going to show you 2 other things that you can look at when you are coming to buy an NFT project, and you want to just double check that they're the right one for you. So there you go. I'll have to try and find that hand movement at some stage. God knows what time it is. 12:27. Let's write this down so I get this right. Timestamp this. So someone do me a favour, actually. If you've watched this far, please timestamp this for Sappy Seals. I think it was like 3 minutes in. Anyway, right, let's talk about why floor sweeping can be a red flag. But first, a little bit of Fanta. I just have a collection of terrible fizzy drinks. Monster, Fanta. I do have some water here, which is a strong move for me. Right. Okay. So, if you run a really, really big company, a $100 billion company, maybe you're in pharmacy, maybe you're in engineering, maybe you built an engine or something. You were a big company, you're very established, you've been around for 70, 80 years. You probably give a dividend of 3 to 4%, 2%, whatever, and you get, I don't know, annual earnings growth of a few percent, 4%, 5%. Nothing stellar because you're already pretty damn big, and you've probably eaten up a large amount of the total addressable market. So much of the market that you could attack knows you exist, knows you're there, has bought from you, doesn't buy from you anymore, doesn't use you, has considered you. There isn't suddenly this whole new pocket of market you're suddenly going to open up. Now, the growth of the global economy, there might be more money elsewhere that might suddenly come online. But ultimately, you have covered most of the total addressable market. So when you have capital that comes into the company from profits or from a good year or whatever, what do you do with it? Now, you can buy shares back, which they tend to do more in America than the UK. You can give dividends, which we do a lot in the UK. We have a lot of dividend aristocrats, as they call them. Or you could invest in new projects and you can grow the business. Now, when you're $100 billion, and I'm saying this from, I'm not talking about a tech sector where $100 billion is can become a trillion. You know, look at Tesla; they were $100 billion. That's different. I'm talking about an established, old school industry, and I'm using this as an analogy to paint a picture of why active floor sweeping by NFT devs as a permanent fixture of the project is a problem. So you're an established business, you're an established sector. It's not a fast growth sector, and you're no longer a fast growth company. You're now a cash cow or a dividend company for investors. If you receive an amount of money coming into your company, there is not much percentage of return you can bring on that capital that investor probably couldn't get from having the capital back themselves and investing it in another sector like tech. So there is a demand on directors of companies or CEOs to provide a good return on capital employed, return on shareholders' funds. Michael Saylor famously has gone into depth on this, and this is why he's become the ultimate Bitcoin mega chad, because he understood that for the money he had been receiving from the sales of MicroStrategy products, he has a fiduciary duty to give investors a above inflation return on that money. So that's the thing as well. It's not just giving them a better return than what they can get in the stock market or elsewhere, or having it themselves in their own purse or wallet. It's actually beating inflation, so the company doesn't get progressively smaller through an attrition, through inflation, through increase of the cost of shipping. I run an e-commerce business and a retail business, it's e-cigarettes. That's my main business, and we still do. We ship items from Hong Kong. They come in containers because they are liquids. They have to take up an entire container, even though they're only a fairly small portion of that container. And the cost of those containers go up. So our costs go up. So we have to either swallow those costs and just take them on board and it hits our profit, our bottom line, or we increase our cost to our end user and hope that they swallow that themselves, and then maybe they demand more in their wages from their workplaces, and we get inflation. We get the cycle of inflation. So there is a cost to use capital, and there's a cost. There's inflations you've got to beat. So we've got to make sure the money we have on the business account can grow along with the growth of inflation. So that's that. So Michael Saylor invested the money in the business, the cash, into Bitcoin because he believed Bitcoin would give him an outsized return based on what other things out there were doing with his money. So as a business, he could put the company's cash in treasury bonds, in savings accounts. If he was in Europe, he could use a negative yielding bonds, so you lose money for putting it in there. He thought, well, that was a bad idea. Not only am I losing on those, I'm also losing against real terms of inflation, and I will take the punt on an amount going to Bitcoin. So that's what he's done for it. So we've heard about this famously. It's important for big companies and any companies to manage investors' money. Money in the business is your money. You have a share of it, okay? Now, obviously, you've got to pay wages. You've got to do everything else. You've got to make sure the business grows. The business has got growth capital. The business has got cash reserves. But it's also got to provide a better return on that money if it's going to hold on to it than just give it back to you. So this is where we get big companies. We go back to the big company story. There isn't a huge amount of growth in their sector. If they've got £1 billion come in, they can go, well, we're probably only going to get 1% on that £1 billion. But if I give it back to you, you've got return of 4% because of your shareholding value or whatever, and you can do what you will with it. Okay, so you can go and make a better decision elsewhere. Otherwise, they're going to have to explain why they're losing money to inflation on that cash. So that's in a nutshell what we often see with big companies is they will pay dividends because there isn't really much more they can do with the money. Now, that was a long-winded explanation, but I hope that makes sense from a big company perspective. Now, if you're Tesla, the reason why Tesla don't give dividends, it might be because there's a personal theory. It may be because it's actually very, very small in proportion to the actual share price, so the dividend percentage seems very, very small. So they're not going to attract dividend investors anyway. But actually, they're trying to grow. Currently, what's Tesla? About 800 billion, 700 billion, 900 billion, $1 trillion market cap company. Kathy Wood ARK Invest believes that company could end up becoming worth, $2, $3, $4 trillion. Okay, so there is the potential over the next 5 to 10 years that company could see a return with the money it's investing and its products and its IP of around about 300-400%. Okay, so let me just bring my screen back. Don't forget to follow me on Twitter, Real to Economist. That's a lot of return. Okay, so they could give you the money back and impede their ability to invest in new infrastructure. And in order to get to that size, obviously that means they need to sell more cars. They need to make more batteries. They need to have more lithium supplies. They need to do a lot more. They need more staff. They'll need more management. They'll need more testing and R&D. And this is a very emerging industry. They could suddenly find themselves from selling cars to actually making automated taxis and providing software for around the world for other systems. Or their systems of building cars could become the go-to. They could end up providing outsourced secondary services. You look at, VW and Porsche have got a tie-up. A lot of these companies have tie-ups. They make, they have one car, but actually they produce other cars as well. So they're going to need that capital. So they can go, hey, here you go. Here's a 1.5% annual dividend. But actually, I think you might get, better returns. Let us hang on to it because I reckon I can give you 25% per annum on that. And traditionally, the stock market gives you over the last 100 years, weighted as an average, about 8% in the S&P 500, about 7 to 9% FTSE 100. So there's a traditional stock market return you expect with your invested money, and there's also growth companies, what they think they can do with it. Okay, so smaller companies, scaling up companies, it'd be better for them to hang on to the money because they can potentially show you much stronger returns on that money than you would get if you just invested it in a tracker fund or a standard stocks fund. Okay, so small companies, growth companies, hang on to the money. They invest it in growing the project, growing the business, growing the network if it's Facebook, growing the sales team if it's a sales project or if it's Peloton. Big companies can't grow much more. They're already kind of at a big capacity. They'll give you cash back. Okay, so then you've got another form of, you've got dividends or you've got buybacks. Now, if you do buybacks, you then reduce the number of shares in issue. And that's always a positive thing because you can then always dilute the shares again and raise more capital. What we've seen actually over the last couple of years with cheap credit, we've seen big companies buy back, and bear in mind, some of these big companies, the bosses are incentivized based on maintaining a share price value or hitting a share price level. They get bonuses for that. Those bonuses are often cheap shares. So what they get is they go, right, I'm going to go and borrow money from the market. I'm going to pay 1%, and our company currently has a profit return rate of 3 or 4%. I'm going to borrow at 1% a billion. I'm going to buy back $1 billion worth of shares. I'm going to service that debt with a fraction of the profits, and I'm going to remove shares from issue from the market. Investors are happy. They've got a higher share price. I've got a higher share price because I've got shares as well in the company. And now I brought the share price up because I've reduced the number of shares in issue. And so I get rewarded for that. And my options become more valuable, my share options, because there's a bigger movement from the now buy price and my options price. And it's cost me nothing to do that. And I can just service that from the increased profits. And now my dividend's gone up as well. So there's a little hokey pokey and trickery. Okay, that's buybacks. There's dividends giving money back. There's tax implications for different ways of doing it, but that's how we generally see it in the stock market. Now, floor sweeping. I see this in a lot of discords in new projects, recently started projects that have just done a reveal. And in the early days, I think I probably wasn't any the wiser. But I often hear people say, oh, they're going to sweep the floor. They should sweep the floor. Now, there is sweeping the floor, which is people other investors who are just buying off the floor. Okay, Yesterday I swept the floor, so to speak, from winter bears. I bought 2 new bears sweeping. I literally just picked up 2 new bears. I thought it was a good price. I don't look at the price where they are now, where they float around. I look at where I think they can get to. So if it's here, 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 I don't get sad that I bought it here if it goes down to here, because I'm thinking for here. Okay, I'm not going to sell it at here at par value. I'm going to sell it there. So that's floor sweeping as well. But the idea of a project doing that, the idea of them returning funds from the project, a brand new project that's got a roadmap to execute, that's got maybe a metaverse, a game, a DAO, staking, investing in other projects, or whatever they're going to do, or new issues of art, or more drops. The idea that they would take that money away from the team, being able to grow the team, being able to build the project, being able to execute, and instead just giving that money back in a very, very short-term fashion, with sweeping a few items off the floor, and therefore creating less liquidity, and therefore making it hard, making like there's less volume trade, so therefore less royalties coming in the future, creating wilder swings in the prices, and also reducing the size of the potential network in the long term, because there's less tokens, therefore there are going to be less holders. That is a very, very alarming, very, very short-term strategy that is never seen by the credible projects as a permanent strategy. It's never, you don't see CryptoPunks do it. You haven't seen Mooncats do it. You don't see Cyberkongs do that. You don't see these big projects do it. They don't need to, because people back the project sufficiently that there's enough liquidity and volume. If you have to use new investors' money to pay out old investors to give them a perceived return, we call that a Ponzi scheme, okay? And that isn't a great look, but also it's just not necessary. If that money instead was invested in the project, investing in building up a team, investing in doing all these number of different things, the potential return could be far greater, the liquidity be far higher, the network can still be the same size, there's still more an issue. And we've already covered earlier on with the Sappy Seals comment, the value of a network goes up as it grows up. It goes up as it grows up. I like that one. Reducing the potential for that network has a real impact. I am in 2 projects that have very, very small runs of tokens. I'm not going to name them because I don't want to make out that I'm fudding them or whatever, but they both have the upside that as soon as there is an interest in their project, their price goes, right? But then as soon as someone starts selling, the price goes as well. There's just not the liquidity. There's not enough space between people. And also, if you've only got 1,000 tokens and maybe only 400 holders, what that means is you have a maximum number of 400 people on Twitter who are going to rock your profile. If you've got 10,000, you could have 4,000 people on Twitter rocking your profile. Everyone goes, what's that new avatar? What's that project? Network effect. So if a project is actively proposing to sweep the floor, then what you have is a great big whopping red flag for an organization that actually doesn't have any plans of what they're going to do and has no confidence and belief in what they're going to do or have any idea where to go. And I think there's an awful lot of projects out there like that who are surprised by the success of what they've managed to achieve. And when you start seeing ideas of things like floor sweeping, it starts to ring alarm bells. Now, there was one particular project who the dev was surprised by the sale of the project because he gave up selling them after about, he'd sold about 50 out of 1,000. Then all of a sudden, 7 months later, they all sold out. If you followed my videos, you'll probably know who I'm talking about. He got into a deep depression. It's not for me, it's not working. And people look for a pixel project and it's sold out without any effort. So it's kind of cool in that respect. He was going to sweep 20 off the floor. And the advice was from all of us, don't do that. Buy a few, give them for giveaways, but don't sweep off the floor. Let the market do that. If the market doesn't do it, and look, it's like building up a YouTube channel. It's like building up a Facebook or an Instagram. If you have to go and buy followers, you haven't done it yourself, and you're always going to know that you've done that. And it's not real, is it? It's not real. So that's what I wanted to talk about. That I think if a project suggests buying the floor as their next move, then they've run out of ideas. They've run out of ideas with the capital. Why? Because we've seen traditionally that big companies that no longer have ideas for scale and growth that return money to investors. The small, ambitious, hyper-growth focused projects who've got lots of ideas and lots of ways they can invest that money wouldn't dream of returning capital just yet because they're not done. These projects we're investing in may be showing some people returns in a day. We've all seen it. We see the whale alerts go on Twitter. But the reality is these are projects you'd be buying into for a year minimum. minimum. And I don't know. I think people have got the wrong mindset for some of these things, and they end up selling, and that's what kills paper hands. But the good thing is they get sold out, and then they get replaced by someone who is a bit more patient. But there you go. So that's one red flag I want to talk to you about. The next one, a couple of two little tricks that I do when I'm looking to buy into a project. So there are a couple of tools out on, let's go back onto my computer. Let's find, I'm just going to bring up a screen first. Let's find Twitter. I want you to, there's not a million ways that you can track projects. So I'm just bring my screen over. So here you go. So here's a Twitter follower audit. So you're looking at a project and you're thinking, am I going to buy into this? What am I going to do? Is it going to be one for me? Should I invest my money into my hard-earned? So what you can do is you can find a number of these kind of projects like this. I'm hoping this one actually works on a free sample. And you can whack in there a Twitter handle and it will tell you how genuine the follower count is. So let's find one and let's do it. So let's find... Right, I talked about them earlier on. Let's have a quick look. It's going to go down like a lead balloon. Right, so this is their handle. It's Paladin Pandas, okay? So, and there's a reason why I'm actually doing this. Click here, okay. Let me do it. Okay, so they were last audited 6 days ago. Follow audit score of 98%. Can you make sure you can see my screen first? You can see my screen, cool. Let's just bring this up. So they've got 1.6% fake followers. That's fine. That doesn't scare me at all. Plenty of active. Seems to have picked up in recent weeks. That makes sense. And you can just see a bit of data on it. And this is a very, very small metric you can look at. Next up, what I have a look at is I also take a look at, that's my new bear, my little puffer jacket. Next up, what I take a look at is the Discord. Now, I don't know if I logged into. Let me just see if I can log into my Discord or a Discord. So, come on the Discordings. So I'm just opening my Discord on another screen. I'm opening my Discord. I've got my Discord open. We'll see live all the Discords. What I'm looking at next is something very, very small because I haven't yet worked out how to spot bots. Well, I can get a good idea if someone's got bots in a Discord if I'm sitting there watching it and I see the numbers just fly up. But I haven't found a tool yet. So if you know one, please put it in the comment below because I would love to find it. But what I look at is the numbers of emoji ticks. Seems random, right? You know those little ticks when they do an announcement? When they do an announcement, how many people hit those emoji buttons? In comparison to the numbers of members of the Discord followers, gives you some idea of how engaged that audience is. Now, there are some issues with that's not perfect because you've got language barriers. So if the announcements are in English and they've got a lot of Chinese or Japanese followers, then it's not necessarily going to be as effective. But it's just another metric you can look at and you can start to go, Also, you can have a look at the conversations in the chat and you can go, right, how much conversation is there going here? How much is it flowing? And again, you can have a look at that and you can get some idea. And you can also look at the standard of comments. If a lot of the questions are, floor price this, floor price that. Let's have a look. So I'm getting smashed up here with nonsense. So let's go down to Paladin Pandas. I'm just going to bring up so my screen's about to crash. Let me just find my Discord. Okay. Why won't you work? Sorry about this, guys. I'm just trying to bring up my Discord screen so you can see it. Oh my god. Add window capture. Create new. This is fun, isn't it? Watch a guy just browsing his screen. Oh, this is bullshit. Right, I'm struggling on this one here, guys, so I'm gonna sack it off. If you've ever looked at a Discord screen, you go into the actual announcements, have a look at those little emojis. Now, if you've got 10,000 Discord followers and you're seeing only 50 emoji ticks or whatever the little ticks are underneath the users, let me try and do this because I do want to show you how this works. Because it doesn't seem, it's not cool if I can't. I will make this work. the meantime, don't forget to follow me on Twitter. Right. Why won't you fucking work? Screen sharing. Display capture 1. Right, okay, this is going to go crazy in a second. You're going to see my entire world. Right. Let's go. Right, get ready for melting your minds. Da, 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 da. So there you go. That's what I mean by the actual. You can see the announcements there and stuff. So you've got those little cues to give yourself an indication of what is an active project. I think those are a couple of things I look at. You can get a general gist of whether or not a project's going to go somewhere as well in terms of initial hype, or you can see the Discord. But I do have a look as well as the integrity or the quality of conversation. I have a look at the people talking in the communities as well. I want to get a gist. Have we got people who've made really good investment decisions in the past? Have we got people with Bored Apes in there? Have we got Cyberkongs in there? Have we got Pudgy Penguins and Sup Ducks and whatever Kaiju Kings or whatever the other projects are? Have we got some interesting Art Blocks people in there, whatever? I mean, Crypto Dad's in there, and I'm looking to try and get an idea of the kind of impact that a reveal is going to have. For example, when you find you have a project reveal, you tend to see the price drop down, people start panicking, and it's just, I don't know, I'm not engaged in sitting in a Discord and just having to deal with that all day long. It bores me. So I tend to, and I think this is why some of the bigger investors tend to wait for projects to kind of start to get on a bit of an upward trajectory, start to build up their follower base, have gone through a couple of dips first. They don't care about the 0.05 to the 0.15 because then to them that's a triple, but it's 0.1 ETH. So you're talking $300-400. They're not interested in all of that work to go into it for that, because their time is a value and it's worth more than that. So I think they're looking at I'll buy at 0.3, I'll buy it at 1 and I'll wait for it to go to 5. I'll buy it at 0.3 and wait for it to go to 1.5. They're more interested in that than the 0.03 to 0.12. It's a game not worth playing. And you kind of want to get it past that, let the follower count increase, the owner count increase, and then they'll get into them. So there's a couple of little, not red flag, but a couple of little monitoring tricks I look at before I get into a project. I want to see if the project has one other thing as well, literacy. I look at literacy a great deal. If the announcements or if the websites are written poorly, they've been written rushed, if they haven't gone to the effort of adding Grammarly to their desktop, then I don't trust the quality of their contracts. And if they haven't bothered to proofread it, again, they don't care about the small attention details. And those things do matter. Not everyone cares about it, but those people who do care about it care. And so if you don't care about them, then you're missing a massive trick. So that's just a couple of little things I look at. But really the key thing is is the one takeaway. There's nothing wrong with a project buying some NFTs off of the floor for giveaways to put into a liquidity pool, say as Winter Bears did. Crypto Dads bought some dads off the floor when they did an honourable Crypto Dad. I made an honourable Crypto Dad for Von Miller, the NFL player, and he listed the ETH price as the number of his shirt, and it got sold very quickly. He didn't expect it to happen. It was brand new in the project, and so what happened was we, as a project, we all agreed, buy a bunch off the floor, stick them in a vault, and in time, when the price goes up, we'll sell those for the charity that money was going to go towards. So that was done for that reason. It's not an active move to floor sweep, and I think any projects that suggest that, they've run out of ideas already, and if they're saying it in week 1, week 2, then they've really that's an alarm bell. Get your money and go. For those who are asking for it, I hope you can see some value in what I'm getting at here. If that project is to grow, it needs the capital to grow. I see people talk about this as well in the Discords. Oh, they're charging an 8% royalty. Well, if it's going to be a DAO project or an investment project, they're going to need that money to buy the artwork to give you a return on your investment long term. The only people who care about that tend to be the flippers, the big institutional investors, the bigger investors, the bigger whales, the bigger people who know how to invest. They're not put off by that because they see that as an opportunity for the project to build up revenue, to enable it to do more things and build up a bigger value. That's it for today. Have an amazing week. I'm probably going to come back again later on in the week. I don't do a stream every single day because I don't want to be boring. Probably have been boring already today. and I would rather talk about something that matters than just waffle every single day. Let's see where crypto goes this week. And one other thing, I made a tweet, right? Careful this week with what you invest in. We all know what happens after Christmas Day. We put Christmas decorations very soon in the bin. After Halloween decorations go in the bin. So if you're buying a project that's particularly branded around Halloween, be very careful as to whether or not it's still going to be something that you're going to be hanging on to or want to hang on to in the days afterwards. You might say, well, that's rather rich from someone who has investments in winter bears. Well, winter bears are investing in an airdrop for summer bears. So, after every winter there is a summer, but winter is about 3 months and Halloween is 1 day. So with that, thanks for watching. Don't forget to follow me on Twitter. And I hope this has been a return of the decency I should have offered Sappy Seals before, with a much deeper look at Sappy Seals. Check it out in the timestamps. Thanks for watching, and bye.